Welcome to the Value Builder Podcast, where we focus on real estate with a value-add mindset. Real strategies, real operators, real outcomes. Let's dive in.
Welcome, Value Builder community. Today I have an amazing guest, an old-timer in real estate, has done a lot of amazing models, and she's still very actively in the game. So we'll dive into that, and I know we're going to learn a lot. So welcome, Kathy. Let's start with can you introduce briefly, just if you can give us 2 minutes commercial, where you started and where you're at right now with your real estate game. And then we'll dive in the nitty gritty of your model and we'll see how people can reach out to you and do business.
When I started, I was like most people and had no idea how to invest in real estate. I didn't have the money. I thought it was something you could only do once you were older and had money. But then we had a crisis. I was married, had 2 young kids. My husband was at the top of his game as a business coach. He had just come out with a book called Extreme Success, was traveling the world. It was published by Simon Schuster, and he was on, Good Morning America. He was basically on the big media tour. And he noticed a freckle. He's a redhead. He was a bodybuilder, so he did a lot of sun tanning, right? Trying to tan for those shows. I always told him, that creates cancer, right? You know that, right? And he's like, no, they've done studies. Anyway, sure enough, it turned out to be melanoma, and the doctor told him he had maybe a few months to live. They thought it had spread. And melanoma is a quick moving skin cancer. He's a redhead with freckles, so especially dangerous for his type of pigment. So it was terrifying. We had these 2 young kids. We had just bought this big house. We were the typical Americans, kind of in over our head, living paycheck to paycheck, big paychecks, but you never kind of know where the next one's coming from, which is, again, kind of standard. I live in LA. People
exactly.
in Hollywood can make a lot of money. Athletes can make a lot of money, but you never know if you're going to get the next paycheck, right? You don't know when it's coming. It's really true for anyone. Anyway, here we were trying to figure out what to do. I had been in the news business. My career was in broadcasting. I had pivoted to becoming a stay-at-home mom during those years when the kids were young. But I thought, oh boy, I gotta get back in there and make some money while he's figuring out, if he's going to live. Fortunately, he's alive and well today. So that's many years later, 25 years later, he's alive and well today. Thank goodness. But at the time, we really didn't know. We blew through our savings. We were doing everything right, saving 10%, investing 10%, doing what our financial planners were telling us. And you would be amazed at how quickly you can blow through all of that when you have a crisis.
Yeah.
So here we were, just trying to figure out what to do. I used my radio show. This was before podcasts. This was, 2002. So I used my radio show just to figure it out. I just started interviewing experts. I interviewed Robert Kiyosaki. I was on a San Francisco major station, so I could really get anyone to talk to me. And I would find out their secrets and learn from them. And it just became my mission to understand how to take over the finances, but go even further than that and figure out how to create it passively so that I could continue to be a stay-at-home mom. So when I discovered real estate, as I talked more about real estate, I had more and more people saying, hey, I want the same thing. So we just started unveiling the secrets of the wealthy. And one of the things was buy and hold real estate. So I learned from Kiyosaki that he was investing mainly in Texas for the job growth, population growth, infrastructure growth of that area, but prices were still ridiculously low. I think I could get a brand new house for $110,000, $1,200-$1,300 a month. Just made sense. So back then you could kind of get no money down loans, in 2003 to 2004 on investor properties.
So question, at that time, Kiyosaki, was he investing mainly in housing, or I think he was investing in an apartment as well. What was that at that time?
I think he had lots and lots of money. He was doing both, but by then I think he was already investing with Ken McElroy in apartments. Yeah. And they were selling most of the apartments in Arizona, California, Florida, the areas that had gone up too much in value, and they were clearly in a bubble, at that time. So he was warning everyone, you've got to sell now and 1031 exchange into areas that were not in a bubble. And that was one of the things I learned is that, we constantly hear about the real estate market, but there is no real estate market. There's just thousands of different markets. And at the same time, same year, same month, you could sell in a bubble at the peak and buy in the trough at another market that's about to peak. So if you play it right and understand your markets, you can do really well. And we did.
That's amazing. How did you do in 2002? So you've been indefinitely, at least in one major cycle and maybe in a few smaller ones.
Yeah.
So I would like to dig in because we don't have that many guests who went through those scars. I've been in 2008, so I remember that.
Yeah.
How did you handle 2008, 2010?
Oh my
Obviously,
gosh.
remember
Well,
that. So what
because
was
I was
that?
already, I don't know, I don't want to say celebrity, but I was well known in San Francisco. I had people saying, wow, I want to do what you're doing. So Rich and I were like, oh my gosh, we can give them the name of our property manager, our broker. We can help them do what we did and buy out of state and make it turnkey, make it simple for them. So we started the Real Wealth Network back then, helping other people who were listening to the show saying, hey, we want to do this too. So when the collapse happened, it was hard to have a $110,000 brand new property go down in value, right? We had helped so many people get out of the storm, out of the bubble markets and into what they call linear markets, markets that don't have these great fluctuations. But on top of it, so you could cash flow, you could buy cheap enough and the rents were high enough to cash flow. But there was also this future growth happening. So many new freeways being built, businesses moving there. I mean, we've seen what's happened to Texas since then. The signs were already there 25 years ago. So the people who listened to me at Real Wealth, and by then I had become Rich uploaded my show, and then I was one of the first podcasters in 2005 when that became a thing. We suddenly had listeners worldwide, people from Australia buying through us, we all over. I had guided so many people into buying in these linear markets like Texas. When the crash happened, I was like, boy, what have I done? Am I going to hurt? Are these people going to be hurt? The opposite happened. The rents actually went up. The rents went up because so many millions of people lost their homes. They became renters, but they still wanted to live in the neighborhood, right? So they might lose their home to foreclosure, but rent the one next door. And that one next door might have been ours. So what we discovered is that we didn't feel it. Our members at Real Wealth, the people we had helped, didn't feel a crash at all. All they experienced was raised rents. And because we bought so cheap in a growth area, they also didn't lose equity. So since then, those properties have gone up 3, 4, 5 times in value. Rents have gone up. Now, you ask how I did personally. Personally, I wrote this in my book, Retire Rich with Rentals. We didn't take my own advice. I was giving this advice to everybody. Get out of the bubble markets. Get into the linear markets where there's cash flow and growth. Instead, we kept 2 properties in California. We bought a few. It's kind of like all over the place. Boise, Idaho, which I think at the time had maybe 2 major employers. Like that also was something I was teaching. Get into an area where there's lots of jobs, lots of diverse jobs. Instead, we go and buy 3 properties in Boise that at the time, there was like 2 major employers, just dumb. So when the recession happened, the values went in half there. So our members and our investors at Real Wealth did great because they took my advice. We personally, we got hammered because I didn't take my advice.
Amazing. That's amazing. Yeah. Yeah. I remember that. Yeah. It was definitely tough. Yeah. But in hindsight, I should have bought more. Obviously, I didn't have clarity. And I remember I was doubting myself. I remember the notion was, well, the values will never come back. And the housing will never come back.
Exactly.
And I kind of didn't want to believe it, but you almost led to believe, actually. Yeah, it's probably true. I did not buy enough. I should have at those times.
Yeah, it takes time for values to come up when they crash hard. But if you are able to hold your property, they generally come back. If we had been able to hold the Boise properties, they'd be worth 3 or 4 times what they are today. But rents went down too, and we'd over leveraged. We were buying these properties 100% financing because we could, and they were on adjustable rate mortgages like everybody else. So when those rates adjusted, we couldn't afford the payments. If you can hold the property, if you can get into a fixed rate, even if values go down, rents probably aren't going to go down that dramatically. And if they do, you need to make sure you've got plenty of reserves in place for that to happen. But in retrospect, had we held and not sort of, been holding on with everything we had to make those payments and finally let go, a few went to foreclosure, some were sold in a short sale. We ruined our credit. It was a very, very difficult time. Whereas at Real Wealth, literally, I won this award with Goldman Sachs for helping thousands of people avoid complete loss. And here I was like, oh boy, well, don't look at me. Yeah. Do what I say, not as I do.
Yeah, so true. So true. So true. All right. No, thanks for sharing that. So tell us, tell me and our audience, I know you have different vehicles to invest and for your investors, for yourself. Can you tell us about the housing, investing in single family homes, how that model typically works for typical investor? And you mentioned syndications. No, these are typical syndications. So, or just if you can give us an idea how that's still working today
Yeah,
in a
sure.
higher interest market where rents are not growing as much as in COVID, but I know you're still very active and you're still doing so. So give us an idea, just kind of, very broad strokes, high level. How does it work?
I mean, on the single family side, we are doing the same thing we've been doing for 25 years, and it works. It works. It's hard to see it in the moment. It's hard. It was hard to see in 2009 when everything was falling apart that things would be okay. It was hard to see in 2012 that prices were going to take off and values in those areas. But you call it buy and hold for a reason. If you're buying in an area that's growing, a lot of these growth plans have been in place for decades. They're not just going to change. So if a city is investing billions of dollars in its infrastructure and its roads and its schools, hospitals, etc., you're going to feel that growth. If businesses are moving there, businesses are still moving to Texas. New Jersey just lost another one because taxes are so high. So our single family brokerage, basically, we help investors buy properties nationwide in the fastest growing markets that we consider linear, meaning there's not going to be these ups and downs. It's going to be steady cash flow and the potential of high growth as well. We still do that. We make it easy for the busy professional who doesn't have time to go to the property, doesn't have time to, look around and figure out the best neighborhoods and find property management. We have all that in place with investors who have used these teams for years, and it all comes with, they come with great reviews, or else we don't refer. So that is different than what you hear a lot of people doing. A lot of times people say you got to get your money on the buy. You've got to, buy something old, fix it up, create, that forced appreciation. That's true, but it's not true for everybody. If there's look at someone like me, I could buy an old car and I could fix it up and I'd get a better deal on it. But do I want that car? No, I'm telling you right now, I do not, because I don't know how to fix cars. I want a new car, and I want that car that's going to take me to wherever I want to go. And if where I want to go is the other side of the country, I don't want a deal. I want a good car, right? That's going to get me there. And this is what so many people miss. They think, I'm going to buy the cheapest house, I'm going to renovate it, and I'm going to have all this built-in equity. And that might be okay for some people, certainly for a flipper. For a flipper, you got to buy super cheap, fix it up, and sell it for a profit. But if you're buy and hold, you need to buy something that's going to take you to where you want to go. And usually that's retirement, right? Most people are thinking, how am I going to retire 10, 20, 30 years down the road? Well, I need a vehicle that's going to take me that far. So we're not trying to drive down the street. We're driving across the country, right? We're looking at the future, retirement. How am I going to get assets that are going to take care of me in 10 and 20 years? And these are usually nicer assets, right? These are things that are well built, that might be on the newer end, that aren't going to need a lot of repairs along the way, that are in growth markets, not out in the, I don't know, the exurbs, I think they call it, not just the suburbs, even further out where you could, no one's going to be out there renting. So we really look for high quality assets, and you're not maybe going to see the biggest discount at the outset. Almost all the properties we bought, we got an okay discount, maybe $5,000, no big deal. But do I care? Like if I bought some of these properties in Texas that were between $120,000 and $140,000 20 years ago. People made fun of me. Why are you paying retail? It's like, because I'm going to have these a long time. If I got a 20% discount, it got those for $100,000. They're worth $300,000-$400,000 today. Who cares? Like, I don't care. I care about my destination, which is where I am today. I am today where I am the person I was trying to support 20 years ago, right? I'm that person now. 20 years passes. It does. Trust me. People don't think it's going to go that fast. It does. And here I am now at an age that I prepared for, and I bought these quality assets, and my life is great as a result of that. So that's our one business. It's just simple, quality, long-term assets. The other side is for people who really don't have any time to do anything. They don't want to get the loan. They don't want to manage the property manager. Even if you own turnkey rental properties, there's still stuff you have to do. You have to make sure your insurance is covering everything. You got to make sure you got the right lender and that you're managing your property. You're spending time on even turnkey. But there's people who are professional athletes. They are actors. There's tech people who work 80-hour weeks. They don't have time for anything. And in that
Exactly.
case, they'd rather invest in our syndications where we do it all for them. And right now we have a multifamily fund. We have a single family rental fund. We do subdivisions. We do really well on entitlement, just taking raw land and entitling it and selling it to builders. So lots of opportunities for totally passive investors.
So let's say on a single family right now, and I'll give you the pass card if it's too difficult right now to answer because of a little different environment. But let's say I remember when I was never buying new. I was that person who was buying fix and flips. That was 10 years ago, right? That was and we built some new, but we didn't build for rental. We built to build and to sell eventually as we built. But I remember, it used to be a form when the rates were low. When the rates were low, we ideally you buy something like 1-to-1 ratio. So that's if you can get $1,500 a month in rent, you want to buy something for $150,000, right?
Right.
I don't think this exists right now
The
anymore.
1% rule.
I think it's kind
I
of
wrote about it in
gone
my
unless
first
it's
book.
in a war zone areas. How does it look right now if you're going at those better areas? How that calculation kind of works right now.
Yeah, I mean, we just bought a duplex in Florida. Florida's on sale. A lot of people just time things wrong because they listen to headlines and they see, oh, prices have gone down in Florida. I'm not going to buy there. They'd rather wait till prices have gone up, why? Florida is still extremely desirable for a lot of people retiring. They just built too much there. They built too much in Texas. But, I'm telling you, a couple of years ago, people were overpaying for everything. Now they can get the right price and they're scared. So it's just a very interesting mentality. But right now you've got Texas and Florida on sale. And these are the two highest growth areas. And we're all in. This is where we've got our funds. This is where we're buying. Like I said, businesses are still moving there. So if you wanted to pay a lot less than other people paid a couple of years ago with the same rents, now's the time. So in answer to your question, with our duplex, we negotiated with the builder. You kind of have to find where the distress is. And the distress is if you're trying to sell property, it's hard today. So as a buyer, you have more power. And as buyers at RealWealth, we're able to negotiate with the builders to buy down the rate for us. So we were able to get an interest rate in the 4% on that duplex. And I think we're cash flowing around $800 a month or so on that. So it just depends on what you're buying. If you're buying a really nice place in a growth area, you're maybe just cash flowing a couple $100 a month. But for most of our clients, most of our investors at RealWealth, they don't need more money. They need less money because they're already in a super high tax bracket. They're thinking about how am I going to replace this high income someday? So it's not so much about what cash flow they're making today, but what they're going to be making in 10, 15, 20 years.
Makes sense. Yeah. So what I'm getting though, so your target markets right now is Florida and Houston, right?
Not Houston, Florida and Texas. We like Dallas, San Antonio, Austin's on sale, but it still doesn't cash flow great. We really like Jacksonville's kind of coming back. Ocala is pretty good. We really like Oklahoma because I think, your audience is going to hear this before a lot of people maybe, but Oklahoma is talking about removing the state income tax. And if they do, they're going to be competing with Texas. Already things are growing in Oklahoma. So we think right now you can buy pretty cheap, but that might change. But all parts of Oklahoma. Kansas City, we love parts of Kansas and Missouri. Ohio is outperforming a lot of areas if you're just really looking for cash flow, higher cash flow. A lot of the areas, the smaller kind of sub-markets or tertiary markets, so not Dallas, Houston, Tampa, not those markets, but the smaller ones. Builders didn't overbuild in those areas. So they didn't overbuild in Dayton. Nobody's like, I'm going to go build a whole subdivision in Dayton. But so these areas are actually having the highest appreciation and highest rent growth because they weren't overbuilt. And
Makes sense.
there's still such strong demand for housing.
Yeah, we have a couple properties in Dayton. I was surprised how well we did actually in this softening of the
Good for you.
rental market in a couple of years. It was great.
Yeah.
So Definitely. Now, do you have any suggestions or how you screen new markets for the leading indicators? Now, I can share, let's say, on our end where we buy warehouses and retail. Typically, it's a rent growth and a median income and density. That's kind of three things that we always look. The first one is population growth. Second is median income, how it's median income growing, and the density. How do you look at any other markets, let's say, on leading indicators? We can definitely see what happened, if the rents are going down, but what is the indication that market is going to be good? Is there tangible data you're touching and you're deciding?
Yeah, for sure. I mean, it's very similar to what you said. We want to see job growth. And if there's job growth, there's usually population growth and wage growth. We also want to see infrastructure growth, cities that are investing in themselves and putting in those roads and hospitals and schools and preparing for the growth that's coming. We want to know that they're business friendly and that businesses are moving there, not moving out. That businesses and people moving in, not out. I see this all the time. People investing in areas where the population is declining. That's not good for real estate. Don't do that. For housing specifically, we want to be in low crime areas. We want to be in an area where there's good schools. You have the largest population today. The largest generation is millennials. Pretty much between the age of 32 and 36 is the largest group of millennials. And they're forming households. They're having children. They're looking to settle in an area where they could raise their kids. It's very different than 10 years ago where they were living downtown. And that's why so many new apartments came online to meet the need of all these millennials who wanted to be cool and hip and live downtown. Well, they don't want to anymore. They want to live where they can have a dog run around and kids running around and have nice schools. So for residential, that's really important to us too. And then affordability, like a lot of that is true for, say, San Francisco, where I'm from and where many of our investors are from. But, you've got the infrastructure growth, job growth, wage growth, but you do not have affordability. So it doesn't work, It's $1 million dump is not going to cash flow the way you need it to.
Exactly.
And $1 million isn't going to get you much there.
Exactly. All right. Well, that was a lot of great information, Kathy. Now, can you share with the audience where can people find you if they want to learn a little bit more about your investment vehicles, if they want to reach out, where can find you?
Okay. Kathy, I'd say RealWealth.com is our business. If you're looking at our syndications or turnkey rental properties nationwide, RealWealth.com. My podcast, Real Wealth Show, and Real Estate News for Investors. I do a daily show to kind of keep people up with what's going on in the world as it pertains to real estate or affects it. And I'm on Kathy Fettke. I'm all social media. I think I'm the only one with the name. So you just, search Kathy Fettke and you'll find me.
That's awesome.
And then I just started a new program called REI Savvy, REI Real Estate Investor Savvy, because so many syndicators made big mistakes just a few years ago. We had a lot of those projects come across our desk and we're like, how are they going to make this work? These are some crazy assumptions. Just assuming rents were going to continue to rise, assuming the cap rates were going to keep going down. Just so many assumptions without thinking, well, what if something else happens? Do we have a backup plan? And they didn't. So I created REI Savvy to help people, especially people who are investing other people's money, just really be much savvier when it comes to underwriting, choosing locations, raising the money. Just making sure, I've made mistakes in the past too, a lot, and I just want to share my lessons and help other people, not make those mistakes.
So that program is more for operators and syndicators, right? Or the
people just wanting to scale their real estate. They're not starting out. Yeah.
Great. That's great. Awesome. Thank you very much, Kathy. I really enjoyed this. Hopefully people learned a lot and they can reach out to you, invest and learn more about your investment products, and hopefully to do another pod sometime soon again.
Sounds wonderful. Thanks so much for having me on.
Thank you, Kathy. Appreciate it.
You've been listening to the Value Builder Podcast. For more strategies, stories, and episodes, head to valuebuilder.co or subscribe on your favorite app. Always make it better than you found it and keep adding value. See you in the next one.